Hello, welcome back. After I made a video about Alibaba, the next one is going to be Meta Platforms, and this one is actually my favorite company right now and my favorite stock for the most part. As I mentioned in the previous video, I'm gonna be making videos about all these companies that have been completely battered down, the giants that have lost a lot of their sparkle, and we're gonna be examining them for a buy. They have gone down tremendously. Like Facebook is off from its 1 year high, 50%, and so we want to examine it, see whether it makes any sense to buy the company right now after it has been battered down so tremendously in the past few months or so. Now, if we take a look at the stock news here, you will see that this is mentioned as a plunging stock that is a fantastic buy right now. And we will see what the company is going to be doing, of course, in the future. But we do want to examine whether it's an interesting and a nice buy for us right now. And of course, this has to do with the financials. And as you'll see here on the preview, everything is green. Everything is a check mark here. But why? The P ratio is at 14.6, which is absolutely insane for a company like Facebook, of course. And the price to free cash flow ratio is also pretty low as well, 13.4. And similarly, another green sign, the outstanding shares of the company have been going down quite some. And I'm pretty sure the company will continue its buybacks. And look at this total liabilities versus free cash flow here. The company can actually pay back all their total liabilities just by using last year's free cash flow. Like, let that sink in for a while. Like, let's take a look at the cash flow statement because this is extremely important. The company generated 39 billion last year, 39 billion. And if we take a look at their balance sheet, all their liabilities, that's the whole gist, it's the same amount pretty much, 40 billion, 41 billion, a little bit more. But this includes everything. This includes debt, all the liabilities here. Look at this, like every liability, like the short-term debt, long-term debt, payables really, everything gets included here in terms of the liabilities that the company has, which includes, again, debt and everything else that the company needs to pay, like suppliers and things of that sort, which is absolutely insane if you think about it. The company, I mean, it has so much free cash flow that they can actually pay all their total liabilities just by writing a check from last year's free cash flow, and that's it. It's gone. Okay, of course they are not going to be doing that because it's bad for leverage, but you can see how solvent they are. Now, let's go back to our stock analysis tool here because you will see that some great things about the company. It has been growing very nicely as well. And remember that this is already a pretty big company from 40 billion to 117, 18, which means that at some point there will be some stalling growth. This is very, very normal. As the company is growing in terms of what they are making, they cannot be growing at the same scale. It's impossible. And eventually they will have to go down in terms of their revenue growth, for example. And it will happen for sure. And it's expected. But the thing is, are they making their balance sheet better? Are they increasing their money in their balance sheet? I have talked about it in the Alibaba video, and many people don't realize that it's a very, very important fact. Take a look at this line here, retained earnings, 34 billion to 70 billion. This means that the company is accumulating income. It is accumulating money, and this is basically the net income that gets accumulated in an account that is permanent. This is a permanent account that keeps increasing or decreasing based on the profit and loss of every period of every year, pretty much, in this case. And so if we go back and examine the company a little bit, I'm sorry, you will see here that the debt of the company is basically non-existent. And without even utilizing debt, meaning that they don't utilize a lot of leverage, the company still makes almost 29% in return on equity. Now, this is something extremely important as well. The company, practically speaking, haven't even tried to use debt that much, really. And they are still making fantastic returns, which is absolutely awesome. And look at this net income, of course. Remember, it's a software company. So their net income is absolutely amazing here. I absolutely love the numbers here. These are insane numbers. And so if we take a look at the income statement, 40 billion to 117, 18. And if we go back to our net income, the bottom line pretty much of the income statement, 16 billion to 40 billion. It keeps increasing tremendously as well. And the the balance sheet we examined, we barely kind of touched it a little bit, but you will see that 74 billion to 125 billion is what they're doing in terms of their total equity, which is growing very, very nicely. And this is another great thing about the company without accumulating a lot of debt. Like remember, 14 billion in terms of total debt. If you take a look at the cash flow, remember it was 40 billion. It's basically 3 times as much as their total debt. Okay, so if we take a look at the cash from operating activities is increasing as well with the net income of the company, something that you want to see, of course. And cash from investing activities in the negative here because the company is spending some for purchasing investments. Quite a lot actually every year. I like to see that. I like a company that is investing in the markets and themselves also with capital expenditures. Very cool stuff. And cash from financing activities is in the negative as well because the company is paying back debt. And also remember, repurchasing common stock like absolute maniacs here. $44.5 billion in repurchasing common stock. Cash at the end of the period, 16 billion from 8 billion, double the cash here, and free cash flow from 17 to 40 billion. This is a company that is absolutely stellar in terms of financials, and some people will jump in and they will say that the revenue growth will go down, the net income growth will go down, but do I really care about that? Okay, what's gonna be happening with the company in the next 10 years? You can kind of see the story if you go back to, the balance sheet here, with the retained earnings over here, you will see 34 billion to 70 billion. I'm pretty sure the next 10 years, this figure here will be maybe 300 billion or something of that sort, maybe even more. So this is what you need to examine from a company, not what is happening in the latest earnings report. This is completely irrelevant. This has to do with hype and the sentiment, really. It's nothing more. And again, the cash flow statement keeps increasing. Everything with this company keeps increasing in terms of their growth here overall. And I love what I'm seeing. And this is why this is my core holding, my largest holding actually in my portfolio, probably by far even. Okay, so actually Baba is a close second, but after that, these two companies are having quite some of my portfolio. And frankly speaking, I don't really go overboard with companies. Like most of my companies, the companies that I own are like less than 1%. But with Alibaba and Facebook, I have got like 5% or so. So I have invested a lot, and I don't typically go more than 5% for any single holding really. But most of my holdings are much less than 5%. Again, they're like 1% or even much less really than 1%, 0.5, 0.3. I prefer to have quite some, but when I'm finding good opportunities, I'm very, very willing to go like 5% of my portfolio. And so over here, you will see that the revenue has been increasing for Meta platforms here. And of course, we expect a little bit of a slowdown. Yes, okay. So we're going to be using lower projections here. So we're going to go relatively low. Let's just go 14, 16, and 18 for what the company is going to be doing in the next 5 years, which I actually think they may surpass. But the net income margins have been near 30%. I'm going to go 28, 30, and 32 over here. And the free cash flow margin, about the same pretty much every year, with slight exceptions, near 100. But I'm going to go 90, 95, and 100 here. And maybe 100 is a little bit too much. Let's just go 85, 90, and 95, just to be more conservative. An annual return of 13% is what I typically want to make. And let's hit calculate, see where we are with Facebook. And take a look at this one. This is insane. The current price of Facebook is 194 almost dollars, a little bit less. But the low estimates are 248. That's the low ones. I mean, I have no words. The medium one is 304 and the high is close to 372 here. And this pretty easily means that the company is extremely undervalued right now based on what they are doing in terms of their financials, that is, because the model here examines what the company's financials are and creates projections based on these financials. This is not random. This is actually mathematics that have to do with what the company has been doing in the previous years and your projections here. And so 248 for my low estimates, this is as the best that you can do in terms of the current price. The current price is significantly less than even my lower estimates here. And so what if I go 0% in terms of revenue growth? I'm curious. So it's only at 0% revenue growth, meaning that the company is not going to be growing at all, that our low estimates are going to be less than the current price. And if I go 5%, then I'm still a little bit lower, but $171. So 5%, of course, as you can understand, is significantly low, with a company generating about 33%, 28. 5% for a year, this is what they do in a quarter. And so, as you can understand, these are very conservative projections, and that are not going to happen, of course. And even 10% here is very limited for a company like Meta right now, and it's still green. It's still $210, 211 really. And so yeah, this company for me is a screaming buy, and this is why I have screamingly bought it. So thank you for watching the video. I hope you enjoyed. Remember to like and subscribe. You can always become a patron. Actually register on our Patreon website. You can find links in the description box below, and you get unlimited access to this tool, and you can analyze all your stocks the way you want them. And thank you for watching this video. Take a look at this one that I made about Alibaba earlier. It's very interesting. It's another great company. And in the next ones, I'm going to be analyzing Apple, Microsoft, Amazon, many companies that are very interesting to analyze right now. And thank you for watching this one, guys. See you soon. Bye.